Hey, good morning, everyone. Marty Mazur here. It is the 6th of December, 2025, with a very quick commentary, and I do mean it this time. I'm going to keep this one quick. Our time right now is really getting devoted to the portfolio heading into 2026. Of course, the portfolio is always a work in progress, but now, looking at next year, looking at the macro setup, updating our thesis in terms of where things are going and are likely to go. We want to make sure that the portfolio properly reflects and expresses where we think the opportunities are going to exist, and of course protect against where the obvious risks lie and the ones that have the highest probabilities. That's where I'm devoting a lot of this normal blog presentation time. So much more to come your way soon.
First of all, let's look at the charts, and then I'll get into some of the data of the week. The S&P 500 daily chart, pretty much what I showed you last time. Remember when we were getting that correction here, a few percentage points, I said, this is pretty compelling. Technically speaking, looks like we could build some momentum and continue further down. However, I did say that do not be at all surprised given seasonality and given what I expected out of the Fed in terms of their reaction function to falling markets, to see this come, roaring back. And here we are getting close once again to that all-time high territory. Not that the technicals don't matter. They do. There's no doubt about it. And we need to take this look in the MACD and the RSI, these momentum indicators. We need to respect this. Those of you who've been watching my videos for years know why. So this says that there's some real downside risk, technically speaking, that there hasn't been a lot of momentum in this move. And I've talked about the breadth of the move not being so great either. We'll skip the longer term charts. I will get back to those, but those aren't looking all that wonderful either. As for the NASDAQ 100 index, or in this case, the ETF that tracks it, same thing. Still got a ways to go to get back to that October all-time high. But as you can see, over the last dozen days or so, only one down day. And we still have the same thing going on with waning momentum. The breadth I mentioned, so the S&P 500 equal weight index, all the same stocks, just each one has an equal weight in the index. You can see it has done virtually nothing since early October. So a couple months, and this one really hasn't budged. I mean, it's budged. It had that correction, but it's still right back up to there. While the S&P itself is slightly higher than it was then, but not quite back to that October 29th all-time high. If I had to guess, I'd say we get there before the end of the year, maybe, and some, barring any, macro surprise, Fed surprise, that sort of thing. The dollar has been interesting of late because yields have risen, but the dollar has fallen. So I'm going to say, folks, that this really reflects the rapidly rising odds of a Fed rate cut on December 10th, which is next week. So that's going to happen, I can say with a great deal of assurance, because the Fed does not like shocking the market, and the market is giving a 96% chance, or futures are pricing in 96% odds of a cut. Of course, it's going to be the commentary thereafter, but my view is that they are reacting to the recent weakness in the S&P 500, just like we talked about. I said look for Fed speakers to come out, and they did. And if they push these odds higher of a rate cut, they'll push this index higher, essentially, and that's essentially what happened. A big driver of currencies is the domicile's interest rate. So often when you see rates move, you see the dollar move, and I'm going to say that this is reflecting short-term rates, not the 10-year Treasury rate, which is giving us an entirely different signal. You can see it's rising. Now, it's been rising with Fed rate cut odds dropping. That is the conundrum, I would have to say, for the Fed, in that the markets, and I've talked about how systemically important the stock market is these days, can't let it break. I think it'll bring on the next recession, and I'm not saying that they will succeed in keeping it from breaking, but ultimately they would like to keep that from happening, and believe me, the Fed doesn't want to get the blame for that. The bond market is suggesting that, maybe you shouldn't be cutting right here. I should say it could mean that. It could be that there was just rotation, right, out of long-term treasuries back into equity. By the way, this is not the bond doing well. This is not the bond price going up. This is the yield going up. And while that's happening, the price is going down. So, you could argue that it's some rotation as well. Time will tell. Very interesting dynamics. We talked about how in September of 2024, when the Fed really did the wrong thing at that time and cut rates, yields popped higher. Mortgage rates went up a bunch and so on. I'm a little more sympathetic this time around to the Fed cutting. Labor data has been weakening. In fact, I'll show you a little bit of that here in a minute, and I think they're getting nervous, but I do think they're nervous about the financial markets, to be honest with you. Gold has done pretty well as those yield cut odds have increased. You can see it's just kind of consolidating right here. You'd think that weaker dollar might be a little more bullish for gold, but like I said, asset classes trade on different things at different times, and a big part of what we do is to keep our heads around what's moving, what correlations are actually moving the things that we're in. Private sector jobs report from ADP showed 32,000 jobs lost net. I think that would have the Fed's attention. Challenger job cuts were down notably in November versus October, which they were up a bunch. But you can see the trend here, and even that November number is relatively high, at least relative to the last 15, 20 years or so. And the year-over-year increase, even with this smaller November number, is like 24%. So believe me, that has the Fed's attention as well. So these are announced layoffs to come. We already looked at Fed rate cut odds. I'm tempted to talk more at you. Again, we are really working through our portfolio and all the dynamics and stress testing it and considering correlations and what our overall macro thesis is for next year. We do think there's going to be a lot of fiscal oomph. We know that with the new Big Beautiful Bill Act, as it's called, really coming into play this next year. There's talk of other stimulus measures, which are very interesting because you don't want to throw too much at the economy when we have underlying inflation pressures, which I'm in the camp that says we do. We also do expect, though, that the overall geopolitical setup may be a bit tamer. I know we've got what's going on in Venezuela and so on, but I can see that the U.S. and China, both sides, are efforting to play nicer going into next year. We'll see if we finally get a ceasefire. Let's pray that we do in the Russia-Ukraine conflict. And so on. So a lot of incentives next year. It's a midterm election year. A lot of incentives to alleviate some of the uncertainty that's hit the economy. Latest consumer sentiment data has gotten marginally better. Still very, very low. Consumers are still very concerned with inflation. I had a friend argue with me here the other day that there really isn't any. He's focusing on the reported year-over-year inflation rate, which is still pushing 3% as of this week. And I'm talking about the cumulative inflation that is keeping the bottom of that K-shaped economy hurting. No ifs, ands, or buts about it. When you look at auto loan defaults and credit card defaults, and you just listen to what they're saying, they just can't really afford much these days. Looking at the earnings statements and reports from places like Dollar Tree and Dollar General, their business is really picking up, and they're reporting that their biggest increase in customers are people that make over $100,000 a year. And I'm not saying it's all bad out there. Macy's just gave us a good report on what they anticipate for Christmas shopping and what they're seeing so far. And so there's good and bad. It's very mixed. But the consumers who don't make a lot of money and don't hold assets, meaning they're not benefiting from this great wealth effect, which is keeping those who have assets out and about in the economy, that's a problem. So that's why I keep reiterating how important the financial markets are to the health of the economy going forward. And please make no mistake, that is not lost on Washington. So next year is going to be very fiscal policy driven. That's going to create opportunities in certain sectors or certain areas of the economy, both the U.S. and globally. And that's where we're going to be focusing on and tilting to going forward, while staying extremely diversified given the environment and hedging where we think we need to. I'll stop rambling there, folks. I appreciate you, as always, for watching and listening. And of course, there's much more to come your way from us over the next few weeks. Have a great one. Take care. Bye-bye.